I'm John Lesky, recently retired personal financial planner and founder of finhealth, a tool to guide you to your financial independence. This is the final in a series of 8 videos that explains finhealth and how it can help you reach your version of financial independence. That is, having sufficient investment wealth to support your desired lifestyle indefinitely without needing to work. It is recommended that you watch the previous videos if you haven't already done so. This video provides an overview of the finhealth personal finance software using the Barber family, referred to in the previous videos as a case study. We'll go through completing the input screen with the information provided by the Barbers. We'll then briefly examine the outputs of the software. It should be noted that there will be some small variations in these outputs from those discussed in previous videos due to a recent update of the software and some minor input changes. I'll assume a successful purchase and downloading of the software from finhealth.com.au. With the download, a link to the free ebook using the finhealth software is also provided. The ebook is a companion to this video and may help to clarify some of the discussion. Downloading and reading the ebook is highly recommended. So now, let's have a look at the software. The first screen you see is the Inputs tab. This screen captures key financial information and expectations that enable completion of a finhealth analysis. We'll spend most of the time in this video explaining its completion using the Barber's information. Two other tabs are visible, a Cover tab and a Warning tab. Both these pages are included in the report prepared by the software. The Warning tab serves to make it clear that the software does not constitute personal financial advice. Rather, it seeks to help you understand where you sit on what the finhealth framework regards as 5 key indicators of good financial health. Returning to the Inputs tab, you can see it's broken down into 5 sections. 1. Personal information. 2. Your household's assets and liabilities. 3. Asset allocation inputs. 4. Your regular, that is non-investment income and spending in today's dollars. And 5. Major once-off cash inflows and outflows in today's dollars. We'll go through each in turn, as if we are Peter Barber doing the analysis. The inputs we'll use are consistent with those provided in the finhealth report attached as the appendix in the Using the finhealth software ebook. It's a good idea to immediately save the file to something of your own choice before entering any information. The autosave feature of Excel is always on, saving information as it's entered. We'll save our file to Barber demonstration. So now let's start with the personal information, and we'll first enter Pete's name. Peter Barber. Then we're asked, does your household include a partner? To which you can only answer yes or no. If you choose no, a number of fields relating to a partner are blanked out on the input screen. However, Pete has a partner, his wife Susan, so we click yes and put in Susan's name. The next field asks for the client's, it's Peter's birthday, his age at his next birthday. He's currently 45, so we input 46 there. For Susan, she's currently 43, so we input 44 for her next birthday. The next field asks for Peter's desired or actual retirement age. This also could be the age for desired financial independence. Like many fields, if you hover over it or click on it, you'll get an explanation of the required data. Now, Pete has a desired age for retirement at 65, but what if he accidentally inputs an age before his next birthday, say 43? Immediately an error message comes up and you can either cancel or retry. The age must be greater than or equal to his age next birthday, or if already retired, equal to age next birthday. So we'll retry that and put in 65. Partner's desired retirement age for Susan, she's hoping to retire at age 60. The final field in the personal information section is effectively asking, to what age do you want to project the cash flows for purposes of constructing the personal financial dashboard? The maximum age is 100, but Pete chooses 90. Next, we move on to the Your Household Assets and Liabilities section of the input screen. Explanations for each of the required inputs are provided whenever you click onto or hover the cursor over an entry cell. Peter estimates that his lifestyle assets are worth $2.5 million. His investment assets are worth $1 million, of which his superannuation is $600,000 and Susan's is $200,000. You should note that neither individual superannuation balances or total superannuation balances can exceed investment assets of $1 million. Borrowings, there's currently $200,000 outstanding on a long-standing home loan, and other amounts owing are virtually nil. These numbers in the household assets and liabilities section allow current estimates of net worth and net investment wealth to be made, as well as providing inputs for the current measures of the investment wealth ratio, the retirement expenditure multiple, plus the tax effectiveness ratio. The next section, asset allocation inputs, seeks information about attitude to investment risk and structure of the current investment portfolio. 5 choices are provided to describe attitude to investment risk. They are very low risk, moderate risk, high risk, or very high risk. Attitude to investment risk is a very difficult one to self-assess, but this is not the time to kid yourself that you're more risk tolerant than you really are. It may be worth re-watching video 6, explaining the growth asset allocation ratio, before deciding on the input for this field. The Barbers choose moderate risk. The choice of your attitude to investment risk drives the target growth asset allocation ratio alternatives that are available. Choosing moderate risk gives Peter a selection of 4 target growth asset allocation ratios: 40%, 50%, 60%, and 70%, from which he chooses 60%. However, had he regarded his investment risk as very low risk, the selections would have been 0, 10, 20, and 30, much lower growth targets, reflecting a more conservative attitude to investment risk. However, we'll set this back to moderate and set this back to Peter's chosen 60%. This target growth asset allocation ratio drives the after-tax, after-inflation investment return used in the modelling. It varies from 0.5% per annum for a 0% target growth asset allocation to 5.5% for a 100% target growth asset allocation. As explained in the How to Use the finhealth software ebook, while a higher investment return will improve the prospective position modelled by the software, the modelling doesn't capture the greater volatility in investment values that almost always comes with higher investment returns. The message? Don't cherry pick your attitude to investment risk to paint a better finhealth picture. Be as honest with yourself as you can when deciding your attitude to investment risk. Now moving on, Peter estimates the Barbers hold $100,000 in defensive assets, implying $900,000 in growth assets. He also estimates that of the $1 million of investment assets, $500,000, or 50%, are well diversified, implying $500,000 are held in some concentrated form, e.g. a few shares. The information provided in this section is used to directly calculate the Barber's current investment diversification ratio. It also provides inputs to the calculation of the current growth asset allocation ratio and prospective investment wealth ratios, retirement expenditure multiples, and tax effectiveness ratios. Next, we complete the regular non-investment income and spending in today's dollars section. This is probably the most complex area of the required inputs to complete, particularly for those who are many years away from retirement or financial independence. However, for most who fall in this category, the assumptions made in this area will heavily influence their likelihood of achieving financial independence as they drive expected future savings and projected investment wealth. It should be noted that expected investment income and interest on borrowings are excluded in the estimates of future savings. In the finhealth software, investment returns and borrowing rates are hard-coded. As discussed above, investment returns are driven by your chosen asset allocation, while interest on borrowings is assumed to be 2% per annum after tax and after inflation. Now there's potential to provide annual gross income, that is income before tax and superannuation, and ongoing spending estimates for up to 3 separate consecutive periods from now to retirement. So 1, 2, 3 for client for income, 3 for partner for income, and then 3 periods for spending. This provides some flexibility to allow for potential changes in career and lifestyle expectations without going overboard. For each period, the user can select a projected annual growth rate above inflation in income and spending from a minimum of 0% to a maximum of 5%. While these bands purposely don't cater for all possibilities, adjusting estimated incomes, spending and growth rates for 3 different periods allow a huge number of combinations to be explored. Now Pete's current gross income is $350,000 that he expects to grow at a healthy 3% per annum above inflation until his age 51. From age 51 onwards, or age 51 to actually his age 55, he expects his base salary to start at $425,000 and to grow at 2% per annum above inflation to his age 55. And then from 55 to retirement, he expects to be earning a base of $475,000, growing at 1%. Susan is currently working part-time, earning $80,000 a year that she expects to grow at 1% per annum above inflation to her age 51. She then intends to go back work full-time and earning $120,000 a year, again growing at 1% above inflation to her intended age 55, after which she intends to back off a little and earn hopefully $100,000 a year, growing at 1% per annum to her desired retirement age of 60. Now, it should be noted also that in the income section, there's scope to include any lifetime pensions that are either currently received or expected to be received in future. These aren't relevant to the Barbers as they do not expect any lifetime pensions, and I'd refer you to the Using the finhealth software book for further discussion if you want to know more on lifetime pensions. Now, with regard to expenses, the Barbers use the 3 periods available to reflect expected changes in spending patterns over the next 19 years. For the period to Pete's age 51, they expect to be spending around $160,000 per annum and growing at 1% to Pete's age 51. However, for the next period, they expect a significant jump in spending to $190,000 a year, growing at 3% per annum, above inflation that is, to Pete's age 61. So 10 years of quite high growth. And this reflects the Barbers' expectations that they will send their children to private schools. Beyond Pete's age 61, they project a levelling out of spending at $190,000 a year, growing at 1% per annum to Pete's retirement at age 65. Now, getting down to desired retirement spending, the Barbers are looking for retirement spending of $160,000 in today's lifestyle. However, they do want to allow that over the next 19 years, there is a rise in living standards and they want to be able to keep up. So they allow for a 1% growth in their desired retirement spending. The spending section, as you'll see, also allows for the possibility of long-term renting, both pre and post-retirement, as a separate input that should be excluded from the spending estimates discussed above. Again, renting isn't relevant to the Barbers, but the Using the finhealth software ebook discusses the rental fields in more detail. The final input section, major once-off cash inflows and outflows in today's dollars, captures 1. Significant expected sales and purchases of lifestyle assets, and 2. Significant payments to or receipts from third parties. 3 alternatives available for each category. Peter has chosen to include 1 in each category. Firstly, $1.5 million in 3 years' time. For a proposed upgrade to a new home worth about $4 million. And 2, an allowance of $600,000 in 20 years' time, acknowledging the prospect of inheritances from parents at some time in the future. Again, please look at the Using the finhealth software ebook for further discussion of large once-offs that for many have a major impact on expected future savings and investment wealth accumulation. With the initial inputs for the Barbers complete, we can now briefly examine the finhealth findings. Clicking the Update finhealth Results button takes you directly to the finhealth analysis selector. The selections available under the Analysis Findings section are 1. Summary Observations. This report directly examines how much annual retirement spending, current and projected net investment wealth could confidently support. 2. Key measures. Among other things, it compares the Barbers' measures on the key indicators of financial independence with the finhealth benchmarks. And 3, a personal financial dashboard showing, based on the Barbers' inputs, how they are projected to track on the 5 key indicators of financial independence to Pete's age 90. Also, there are 9 charts to examine. The final 6 repeat the charts that comprise the personal financial dashboard, but facilitate a more detailed examination. However, the first 3 charts provide additional insights. The gross incomes chart graphically displays the income assumptions that the Barbers have made. It provides the opportunity to visually review the reasonableness of those assumptions. Most people find it difficult to grasp what their estimates regarding projected growth rates above inflation for income and spending imply, particularly when these growth rates are applied over extended periods of time, up to 19 years for gross incomes in the Barbers case. The Barbers cash flows chart reveals the real, that is after inflation, and after-tax cash flows implied by the Barbers assumptions to Pete's age 90. Both cash inflows, the blue line, and cash outflows, the red line, are ongoing. That is, they exclude once-off inflows and outflows. The final chart is the investment wealth accumulation chart that captures how the Barbers expect to accumulate their investment wealth over time. In their case, the upgrade of their residence in 3 years' time results in their investment wealth going negative. It then steadily increases to its maximum at Pete's age 67. Investment wealth is then drawn down to fund the Barbers' projected retirement lifestyle. To save a copy of a finhealth report as a PDF, press the Save Your finhealth report as PDF button. An 8-page report is produced. It consists of the cover sheet contents, the warning sheet contents, a repeat of the inputs provided, the summary observations report, the key measures report, the personal financial dashboard comprising 2 pages, and a glossary of key terms used in the report. This report can be printed and/or saved to a file of your choosing. To return to the Inputs tab, press the Return to Input screen button. You can then play with the inputs as much as you like and view the results to obtain a sense of the types of changes that may be required for you to have a high chance of becoming or remaining financially independent. That completes the 8-part video series explaining both the finhealth personal finance framework and the use of the finhealth personal finance software. It may help you to consolidate your understanding of the finhealth approach if you download and read our free ebook, What is finhealth, at finhealth.com.au/free copy of What is finhealth ebook. You can purchase the finhealth personal finance software at finhealth.com.au/finhealth software for $39.99. Please make sure you have access to an appropriate version of Microsoft Excel before making a purchase. Even if you don't purchase the software, the accompanying ebook using the finhealth software will provide you with a better understanding of some of the key concepts that underpin the finhealth approach to personal financial management. It can be downloaded for free at finhealth.com.au/using the finhealth software. Now please provide any comments or questions below. While I have a number of future personal finance videos that I intend to do, it would be better if these videos were responding to some common themes emerging from your feedback. Finally, thanks for watching.